For this video, we wanted to talk about the constructive sale rules that apply when a U.S. person is trading stocks, bonds, other types of securities. So under the U.S. Federal Tax Code, there's a lot of different types of tax rules that apply to the purchase and sale of stocks, and a lot of them are anti-tax deferral kind of measures, right? So they were put in place to try to prevent taxpayers from artificially deferring or eliminating gains on the sale of their stocks or bonds. So the constructive sale rules are one such measure. So if we start, let's just start with the code section itself, right? So the relevant code section is Internal Revenue Code, IRC section 1259. And what this section states is that a constructive sale requires a taxpayer to recognize a gain where the taxpayer hasn't actually sold the stock. Okay, and where this often occurs is when a taxpayer has an appreciated position in a stock and then enters an offsetting position using either a short, an option, or some type of forward contract. So, of course, examples are the best way to illustrate this. So let's look at a simple one here. We have John buys 50 shares of Exxon at 65, so he paid $3,250 in total, and that was on April 1st, 2021. The stock increased to 85 per share, and John decides that he's wanting to hedge his gains, right? So what he does is he takes a short position, 50 shares at 85 a share on June 15th, 2021. Now, what does John's portfolio look like? He has a long position and a short position in the same security. He's long 50 shares at 65, and he's short 50 shares at 85. He hasn't actually sold anything yet, right? So this first position, 50 shares long at 65, hasn't sold it. He still has it. This strategy is frequently called shorting against the box, right? So what are the tax implications here? This is where the constructive sales rules step in. So under these rules, John has to recognize a short-term capital gain of $1,000, $20 per share increase times the 50 shares on the original position. The capital gain has to be recognized even though he didn't actually sell it because he entered this short position, right? So that's the constructive sale. Because he entered that short position to hedge his earnings, he has to recognize whatever the gain was on the date that he entered that short position. So he had 65 per share. It increased to 85 per share. So that's the $20 per share increase. 50 shares he's holding long. So that's $1,000 in short-term capital gain. That's what he has to recognize on his tax return, even though he hasn't actually sold the stock yet. So how do taxpayers track these issues? Well, they can be quite complicated. So fortunately, your stockbroker will do most of the work here. If you're buying and selling with the same brokerage account, they can track these constructive sales. They can track short sales, wash sales. They can do all of this. And so the broker will track it and report all of this on the consolidated Form 1099 that is issued to you at the end of the year, and a copy goes to the IRS. Now, here's where it gets more complicated. If you're a U.S. taxpayer and you're trading using multiple accounts with different brokers, then the brokers aren't going to be able to track this because you're not using the same one. Okay? They're all going to have different systems. They don't talk to each other. So, for example, if John takes that same long position in Exxon using his TD account, and then he takes that offsetting short position in his Charles Schwab account, this still creates a constructive sale for John because he's the U.S. taxpayer. He's the holder. But neither TD Ameritrade nor Charles Schwab are going to know about these offsetting positions, right? TD Ameritrade isn't going to know that he's long Exxon on their account, and then he entered a short in his Schwab account. So this information won't be reported on the 1099. So it's John's responsibility to consolidate all of his activity across all his brokerage accounts and then report this appropriately on his Form 1040. There are a lot of service providers out there that will allow you to download the raw data material from TD Ameritrade, Schwab, Robinhood, whoever you have, and then you can upload it to their system, and they will track for you what are your constructive sales, what are your wash sales, and then you can use that information on your Form 1040 tax return. So if you're using multiple accounts, that's what I would recommend doing, just to make sure you get everything as accurately as possible. If you're using this same brokerage account and you only have one with one broker, you could probably get away with just using whatever they have on their consolidated 1099 at the end of the year, and that should be appropriate. So that covers all of it for constructive sales. I hope that was helpful. Thank you for watching. If you have any questions, please leave me a comment below. Happy to answer any questions I can. And of course, I look forward to seeing you in the next video. Thank you.